Hi everybody, this is Helen Chong and thank you so much for watching. Well, today I want to share with you guys something about a very common question that real estate investors always ask me. Where should I invest? Well, this is a very tough question. United States is huge, California is huge, or even just saying Northern California, that's huge. So how do you find the right market to invest in? So this today I hope that to share with you a little tips so that I can help you to focus, because in anything in life you gotta focus in order to pick the right property. When you can narrow down to just a handful of areas, when you find the properties, you know exactly whether you're going to invest in it or not. So let's get started. Number one, you can start off with 10 or 20 cities that you have chosen or you have some kind of maybe relationship with. As example, maybe you had grown up in that town, or you have relatives there, or you have gone to school there, or you've heard that this market might be a good market. So you just list out all in a spreadsheet, 20 different properties. But next thing is that you need to start gathering these data. You need to find out about their population, the population growth for the past 20 years. Right now, we like to use comparing the population in 2000 versus the most recent data that you have for the population. And so that you can look at what is the population growth and then what is the income growth in that area, comparing the same period of time, maybe income for that area in 2000 compared to the most recent year right now. As of right now, is probably about 2018. That's the most recent data that we have. And also the house value. So you can see what is the growth rate for this particular time frame, maybe for the past 10 years. And then the crime rate, same thing, comparing for the last 10 years. Is it going up or going down? You want to invest in an area where the crime rate is going down, right? And then lastly, for my first step is that I'm also going to compare the job growth. Are there more jobs that coming to the market? Is there a higher percentage job growth or lower percentage job growth? So you can compare. Now that you have 10 or 20 cities, now you have all this data, you can now comparing which ones are the top 5 cities, which one are better than the other ones. Now you narrow down to 5 or 3. I kind of prefer 3, but I know some clients still I still want to pick 5. Then we go to step 2. Now step 2, this time we are a little bit more focused now. What we're going to check is that there are a few things I would check. I look at the IRS tax migration. There is a website, just type in IRS tax migration, and then you can compare cities that whether they look at people's tax filing, whether the monies are going in to the city or going out. There are always going to be some in and some out, but is it more in or more out? And then you can also see where did the money come from or where did the money go out to. So this is quite interesting. And then once you start looking at that, you can type in the numbers. Is it positive? A certain $1 billion or $100 million and stuff like that for those 5 cities. Then I'm also going to do some research to find out the vacancy ratio for apartment buildings in those cities. What is the vacancy rate? The third thing, within this exercise, I will look at whether they have more permits being issued to build or less permits being issued to build. And then what are the average rent for a 2-bedroom apartment unit? And then also what is the property tax rate and also the cap rate. Now the property tax rate and cap rate is probably not as important, but it is also a good indicator. Once you have all the other numbers to compare with, then you can maybe, if you have some numbers that are very similar, then you can compare the cap rate and also property tax rate like that. Now, after these numbers being put together, then I can again narrow it down to less cities. I think this exercise is very, very important, because especially if you have a spouse saying that, well, I don't understand why you pick these cities, then you can actually show them that this is the reason why. Or you have an investment partner, or you need money from other investors to lend you the money. You need to explain to them with data that you put together how you chose these properties. It's not wise to just say, this is because somebody told me that I should invest here, because I read it on the news, because I read it here or there. You need to do your own research. It's really important that you need to prove why you're doing what you're doing by providing data. Now, lastly, now that you have narrowed down to 3 cities, let's say, I'd also do additional research. I like to go to their city planning website, where I just type in the city name, the planning department, and then I go into the planning website, look for their general plan. Typically, it's a long-term general plan because I want to see what is the city going to do in this area. Once I find that, a lot of times they call it 2040 general plan. Once I find that, I pull that up, I kind of look through quickly, maybe the table of contents, and I find that where it's redevelopment. I like to see something about redevelopment projects. Then I'm going to say, okay, there's an area that's not so good right now. They're going to be redeveloping that area. So I go to that page, and a lot of times you'll find that they have a vision for that pocket of this city, and they're going to do some redevelopment in this area, meaning that they're going to encourage more businesses to come in, encourage more developers to build newer buildings. So that area is going to change over time. Then now I know that, okay, these are the pockets that I'm going to be focusing on. Next, I'm going to go to realtor.com. At this time, I used to go to Trulia, but now I go to realtor.com to find this value heat map. I want to look at the heat map. It's color coded, and I would compare, like maybe I would look at that general area, the pockets where they have some kind of developments, and I would look for lower value and then next to some higher value area, and I would probably invest in somewhere on the border. Because the main reason is because I want to see that if there is any kind of development or improvement, it's going to come from the nicer area to the bad area. And I won't buy in an area where it's right in the middle of all these lower income, because you might not have as much appreciation that way. So I tend to like to buy in the border. Next thing is that I also look at the crime rate. They have a crime rate heat map on realtor.com as well. And then you also look at comparing like nicer area, we sometimes call it more stabilized area, next to some a place that might need a little bit more improvements, have a higher crime rate. But I also look at the border, because again, if there's any improvements, it would kind of get close to the border first. So I think these are the very important things. When I first started investing, I had a folder full of research. I didn't have, our internet at the time wasn't as robust compared to right now. So I would print out everything. I would compare neighborhood by neighborhood. I knew street by street whether this is like up and coming. I knew that if it's like west side of this street, then it's a more expensive area. East side of this street is going to be less expensive, and I will be focusing on just the border, like maybe within 3-4 blocks of that street, so that I know over time this area is going to improve. So I hope that this is going to help you to identify the markets, because I know it is one of the most difficult tasks when you start investing. So if you have any other questions, feel free to contact me or schedule a consultation. Just go to calendly.com/Halen, or just subscribe, and we will share more and more videos in the future. Thanks. Bye-bye.